Stocks. I'm your host, Victor Dungo. Last time we spoke about the quantitative and the qualitative analysis of a stock. We shall be taking a step further to discussing what the quantitative aspect of stock is. When you talk about the quantitative aspect, we are talking about the financial statements, the returns, the price for which you are getting that share and all sorts. The first step we shall be taking today is discussing the income statement. I'm just going to portray a bit of what the income statement is about. If you really want to know more, I'll recommend a book written by Benjamin Graham and Spencer Meredith, The Interpretation of Financial Statements. This book was written in 1937. For me, it's still valid till today. Another one is Financial Statement Analysis by K.R. Subramaniam. Yeah, it's a fantastic book. It covers almost all aspects of a financial statement. The only part I would not really recommend you read or perhaps just jump over is the part that wants to speak about valuation and stuff like that. That is not my style. So let's dig into this very particular aspect. We are starting today by setting up a business. It's going to be a cupcake business. I've got here this is a flour which we have bought for $1, and then the other one is sugar which we have bought for 50 cents. So these, I would say, are the raw materials for our flour, for our cupcake business. We are just going to restrict ourselves a bit to just these two ingredients, and we want to go in the business of making cupcakes. This normally we'll class as our inventory at the start. Let's assume that at the very beginning we had just about $10 to start this business with, and of this $10 we have gotten flour, sugar. In the process, we then made this to, let's see, 12 cupcakes. Let's say we took 30 cents of flour, 25 cents of sugar to make 12 cupcakes. So these 12 cupcakes, we then decide to sell one cupcake for $1 each. Let's then go forward and just do a quick income statement. Income statement has to do with the revenue. Revenue is your sales. So you have all your sales, then you deduct from your sales the cost of doing that business to generate that sales. Anything you then have left, you tax it, and then after taxing it, you have net. That net is supposed to be for you. So let's quickly delve into this particular scenario. Let's say out of these 12 cupcakes, we sold 10 cakes. In our income statement, we will say revenue is equal to $1 times 10 cupcakes sold. So that will give you $10. Then the next line would be cost of goods sold. So this particular one actually refers to having to produce these cupcakes itself. So you are looking at the 30 cents of flour that is used, 25 cents of sugar that is used, include the labor that is used to produce these cupcakes with the cost of goods sold. So let's assume that the labor for producing this 10 cupcake is $1.25. In total, we now have $1.80 as cost of goods sold. So it means out of this revenue, it has costed us $1.8 to actually produce these cupcakes. So what you then do is to deduct this one from that. So when you deduct that one, you're going to have what you call gross profit, which is equal to $8.20. This $8.20 is very, very crucial. This is where you need to watch. Some companies have very slim gross profit, such that if there is a small shift in the cost of raw materials, or there is a small shift if labor then tends to unionize, it jacks up your cost of goods sold. Those working in the factories and stuff like that decide to unionize, it jacks up your cost of goods sold, and then your gross profit drops. So very solid businesses that make this wonderful cake, right, need to watch that. Need to watch the cost of goods sold, and if there is an increase, you should be flexible enough to actually pass it on to the customers to actually bear the cost, so that you can still in a way maintain your gross profit margin. So this can be expressed in percentage as 82% gross profit. Well, this is quite a lot for a manufacturing company, but I'm just trying to do this so that you understand what it is. For a good manufacturing company, you are looking at gross profit of roughly 30 to 40%. That is for a good one, but there are others that can even have greater than 40%. So this is solid. Next, we then have what you call selling, general, and admin costs or expenses. So this is where you put in your advertising cost, your office rent, your administration costs, admin staff costs, all sort of costs that pertains to running this business. So let's assume that all of this comes down to roughly $5.10. So you then subtract that from $8.2, and that is going to give you $3.10 left. So this is what you call your operating profit. That's your operating profit. This operating profit is profit that has to do with you running the cupcake business. Then you can have other income. I don't want to go into that. Some businesses can have some investments. So if you have some investments that bring you a bit of money from outside, you can then add that to what you call other income or other expenses to the $3.10. So that is that. After the operating profit, in the UK currently, companies pay 19% tax. So your tax is going to be 0.19, that's 19%, times 3.10. That will give you roughly 59 cents in taxes to pay. So if we pay that $2.51, so that's what's going to be left for the owner. So this is what an income statement looks like. There is something I need to stress about. Revenue is not the same thing as cash. There's a big difference. With revenue, there's a way you recognize revenue. If you have a contract with someone and you have fulfilled the terms of the contract and you have transferred the product to that person, he now bears the ownership, or the services are complete and the person is satisfied, you then go ahead and recognize that revenue. Whether you have been paid or not, you recognize that revenue. So it's actually possible to have revenue and still be poor, not make money. Cash is king. So in the case of these cupcakes, we made 12 cupcakes. Let's assume out of these 12 cupcakes, I sold 10. But of the truth, these 10, I was only paid for 7. The other 3 is what you call buy now, pay later. Even though I have no money from the other 3, I'll still go ahead and recognize that I have sold 10. But on another side of the financial statement called the cash flow is where I begin to state that, look, though I recognize revenue for 10, but actually I didn't get the money for all 10. I got money for 7 and remaining 3. Those 3 that are remaining go under the portion called receivables, changes in receivables. So let's just understand that revenue is not cash at all. So furthermore, when you see this net profit does not actually mean this is what you have made in terms of cash in your pocket when you do this business. For you to really see the cash, which is king, in your hands, you need to go to a portion called the cash flow. So income statement is a precursor to the other parts of the financial statements. Again, another point I need to stress on the income statement is when you're looking for companies, you want to look for companies that have generated revenue but have not used all these revenues on expenses. You know, expenses is giving out. A business actually has to make money in. So that is what is important. So in relation to the revenue, you want to actually look at the net profit that is left. And you need to build this picture over the years. So you need to build it over year 1, 2, 3, 4, and so on and so forth, to actually understand the earning power of that business. So if you look at the net profit, try and make it a percentage of the revenue that is left. And try again, there are ways company somewhere around here, selling, general and admin, massage the operating profit. And then there are other ways again through the use of figures in here to massage the operating profit. Imagine some of them can sell an arm of the business and make a profit on it and bring in here and use it to increase the operating profit. There are other costs, for instance, depreciation costs, that they can actually change the normal way they have been doing depreciation. There are various ways you can do your depreciation. You can do straight line, you can do accelerated. But some of the businesses, what they do is when things are not going well, they might want to change and then in a way to actually increase this operating profit. So there are very many ways companies can massage all of these. Charge less in terms of depreciation and amortization, charge less in terms of selling costs. They can sell part of the business and use it to pay some of these costs and not recognize it. So therefore, decreasing the effect on the income statement. So all of this you need to watch for. That is why you need to build a picture of the business from year 1, 2, 3, and 4 to understand their practices in terms of recognizing various costs. For me to be interested in a business, when I look at the net profit, it must at least be 10% of revenue. If you don't take anything from these, it should be at least greater than 10% of the revenue. So in this case, this is about 25% of the revenue that we have. So this is quite interesting. This is quite an interesting business for me to want to go on further to analyze. So, ladies and gentlemen, this is a very small part of the financial statement we have dealt with called income statement. Next time we are going to speak about the cash flow statement, where we begin to recognize the company's use of cash. I hope to see you next time. Thank you and bye.